Hey everyone, and welcome to your personal deep dive. Today, we're diving headfirst into the world of investing with, you know, John Bogle's The Little Book of Common Sense Investing.
Mm.
Get ready to challenge some conventional wisdom.
Yeah, we're going way beyond like the typical buy low, sell high advice. We're going to explore those surprisingly simple strategies that can truly make a difference in your portfolio.
Yeah, and you know what's funny? Bogle actually argues that for most investors, the best approach is, get this, to don't just do something, stand there. It seems kind of counterintuitive,
It
right?
really does go against our instinct to act, especially when the market feels like a roller coaster.
Yeah.
But but there's a powerful logic to it. Let's maybe start with the parable of the Gotrox family that Bogle uses to illustrate this whole idea.
Okay, yeah, let's unpack this whole Godrock story.
So picture this.
Hmm.
A family that owns every single share of every business in America. They're baking this enormous economic pie every year. All the profits, the growth, everything goes straight to the Gotrox.
So they're basically set for life. They've got it made.
Exactly. But here's where it gets interesting. Some family members, they get antsy. They're not content with their already huge slice of the pie, right? They want more. So they start hiring helpers, financial advisors, brokers to try to outmaneuver their relatives and get a bigger share.
Oh, okay. So they're essentially paying people to try to beat the market, even
Yeah.
though they already own the entire market. That seems a little, I don't know, redundant, doesn't it?
That's the irony. And of course, these helpers, they don't come cheap. They charge fees, commissions, all that, and those costs come directly out of the Gotrox pie. But it gets even worse.
Worse than shrinking their own slice of the pie.
To justify their fees, right?
Yeah.
The helpers, they feel this pressure to be seen as doing something. So they start churning the Gotrox portfolio, buying and selling, creating more transaction costs, more taxes, all eating away at the pie even faster.
It's like paying someone to take bites out of your dessert before you even get to taste it. It's a recipe for disaster.
Precisely. And that's the core message Bogle wants to drive home. The more you try to outsmart the market, the more you let these costs chip away at your returns, the less likely you are to actually grow your wealth over the long term.
Okay, so the Godrock story, a pretty clear illustration of how fees can, eat away at your returns. But let's connect this back to the actual stock market. Bogle talks about this crucial distinction between investment return and speculative return.
Right, and this is key to understanding how to approach the market. When you invest in stocks, you're buying a small piece of businesses, just like the Gotrox. Now, there are two components to the return that you get from that investment. The first is investment return. This comes from the actual growth of those companies, their earnings, the dividends they pay out. It's the real growth of the economic pie.
It's like the difference between betting on a horse race and actually owning part of the racetrack.
Yeah, exactly. Now, the second component is what Bogle calls speculative return. This has nothing to do with the underlying businesses, but rather with how much other investors are willing to pay for those businesses at any given moment.
So it's driven by sentiment, by news, by speculation, essentially, the buzz around a stock or the market as a whole.
Exactly. And that buzz, it's constantly fluctuating. It's emotional, it's unpredictable, and it is very difficult to time correctly.
Which is why you see those wild swings in the market. It's people reacting often irrationally to these speculative forces.
Precisely. Bogle argues that trying to time the market based on these, short-term fluctuations is like trying to catch a falling knife. You're far more likely to get burned than to succeed consistently.
So if you subscribe to this idea, does that mean you're simply stuck accepting whatever the market happens to deliver?
Not at all. While we can't control the market's ups and downs, we can control something that has a huge impact on our returns, the costs we pay to participate in the market.
Costs, the silent killer of returns. Everyone knows they matter. But Bogle really drives home just how significant even small differences can be over the long run, right?
Absolutely. Think of it like this. Every dollar you pay in fees and expenses is a dollar that is not compounding and growing for you.
It's like having this little gremlin sneaking into your account every year and just taking a bite out of your earnings.
Yeah.
And as you mentioned, this compounding effect, this is where the real magic of investing happens.
Precisely. Even small differences in fees can snowball into massive differences in your long-term return.
Okay. Can you give us a sense of just how dramatic this impact can be? Can you put some numbers to it?
Absolutely. Let's say the market delivers an average return of 8% per year over the next 30 years. Not an unreasonable assumption. Now, if you invest in a low-cost index fund with an expense ratio of, say, 0.2%, you'd end up with a considerable sum. But if you invest in a pricier, actively managed fund with fees around, say, 2%, the difference is staggering. You could end up with, significantly less, even if the returns are the same.
Okay, so we've established that costs are a major, major factor. But aren't mutual funds often marketed as a way to outperform the market, to get those above-average returns that really move the needle?
This is where Bogle pulls back the curtain and exposes what he calls the grand illusion of mutual fund returns.
Intriguing. Tell us more about this grand illusion.
You see, those impressive numbers mutual funds advertise, they don't always reflect what investors actually pocket.
Wait, how is that even possible?
Well, it comes down to a few key factors. First, there are those pesky fees we've discussed, right? They take a bite before you see any returns. But there are two other culprits, market timing and fund selection.
Okay, let's unpack those. First, what does Bogle mean by market timing?
Market timing is this tempting idea that you can jump in and out of the market or specific funds at just the right time to buy low and sell high. The problem, it's incredibly difficult to do consistently, even for professionals.
It's like trying to predict the future with a magic 8-ball, right? You might get lucky once in a while, but more often than not, you'll end up frustrated.
Exactly. And most investors, they're not clairvoyant, right? They tend to get greedy when the market is soaring, buying high. Then, when things inevitably cool down, they panic and sell low.
So market timing, while enticing, is more likely to hurt your returns than help them, especially over the long haul.
Absolutely. And that brings us to the second culprit fund selection. Imagine trying to pick, the single best restaurant in a city filled with amazing options. It's overwhelming.
And then even if you found an incredible place last year, there's no guarantee it'll still be the best this year.
Right, precisely. Investors often fall into the trap of chasing past performance, assuming that a fund that did well last year is a sure bet. But as Bogle points out, that's rarely the case. Those top performers, they often revert to the mean, meaning their stellar returns don't last forever.
This is painting a rather bleak picture for anyone trying to navigate the world of actively managed funds. It sounds like the odds are stacked against them from the start.
That's the unfortunate reality. But here's the good news. There's a simpler, more effective approach that Bogle champions. It's the idea of owning the entire market through low-cost index funds. But we'll dive into that right after a quick break.
Picking up where we left off, the beauty of index funds is really in their simplicity. Remember the Gottschalk family. Instead of trying to outsmart each other, what if they just, held on to their original share of the entire market? That's essentially what an index fund allows you to do.
So instead of trying to pick individual stocks or time the market, you're buying a tiny piece of every stock out there.
Precisely. You're not putting all your eggs in one basket. You're spreading your risk across thousands of companies. This built-in diversification it's like a safety net for your portfolio.
That makes a lot of sense. So if one company goes belly up, it doesn't take your whole portfolio down with it. Exactly. And since index funds simply track the market, they don't require a lot of buying and selling, right? That translates into lower costs for you, both in terms of those pesky expense ratios and transaction fees.
And we know how important those low costs are for long-term returns. But do index funds actually perform well? Can something so simple really compete with, those actively managed funds?
That's the surprising part. Bogle's research shows that index funds have consistently outperformed the vast majority of those actively managed funds over the long run. And it's not just by a small margin either.
Wow, so much for the fancy algorithms and the high-priced analysts. What's the secret sauce? How can a simple index fund beat the experts?
Remember those relentless rules of humble arithmetic we talked about? Costs matter, and they matter a lot. Index funds, with their inherently low costs, they have a built-in advantage right from the start. It's like they're running a marathon, but they get a head start while everyone else is still, tying their shoelaces.
So the longer you invest, the bigger that advantage becomes.
Exactly. That's the beauty of compounding. Now, some might argue that index funds are too boring, that they don't offer the excitement of trying to beat the market. But remember, we're talking about building wealth here, not winning a game show.
Right. It's about playing the long game, not making a quick buck. But this begs the question, if index funds are so great, why isn't everyone investing in them?
Well, for some, it's psychological. People, they like to feel in control, like they're making, clever decisions. Index funds can feel too passive, too hands-off.
It's like the difference between choosing your own lottery numbers and letting the machine pick them for you.
Right.
Even if the odds are the same, it feels more exciting to be, like, in the driver's seat.
Exactly. There's also the influence of, the financial industry. They have a vested interest in promoting actively managed funds.
Yeah.
That's where they make their big bucks. They've spent like decades convincing people that they need expert help to navigate the market.
So there's a whole system in place designed to keep people believing in the myth of active management. It's eye-opening, to say the least. Now, speaking of different approaches to investing, Bogle touches on a newer development in the world of index funds, uh, fundamentally weighted index funds. It sounds a lot more complex than just tracking the whole market. Can you break it down for us?
Of course, in a nutshell, these funds try to improve on the traditional index fund by using like fundamental factors, think a company's earnings, dividends, or even its book value to weight the stocks in the index differently. So instead of simply weighting companies by their size, which is what a traditional index fund does, they're trying to tilt towards companies that might be undervalued by the market.
So it's still an index fund at its core, but with an added layer of analysis, kind of like choosing a basketball team based on their stats instead of just picking the most popular players.
That's a great analogy. And proponents of this approach argue that it can lead to higher returns in the long run, by exploiting inefficiencies in the market.
It's certainly an intriguing idea. What's Bogle's take on these fundamentally weighted funds? Is he on board with this approach?
Well, Bogle doesn't completely dismiss them. He acknowledges that these funds have, shown some outperformance in certain periods. However, he cautions against assuming that this outperformance will automatically continue into the future. Remember, past performance is never a guarantee of future results.
Because he's saying, like, don't get blinded by the hype.
Exactly. Bogle also raises concerns about the higher costs that are often associated with these funds because they involve, more active decision making in constructing the index. Their expense ratios tend to be higher than those, super lean, mean traditional index funds.
Yeah.
And as we've discussed, those costs can make a huge difference over time.
They can really eat into your returns like termites in a wooden house. Now, shifting gears slightly, I'm curious about your take on exchange-traded funds or ETFs, as they're better known. They've exploded in popularity recently. What are they, and how do they fit into Bogle's philosophy?
ETFs on the surface are actually quite similar to traditional index funds. They both track a specific index, and they both offer that valuable, instant diversification we talked about. The key difference lies in how they're traded.
Right. ETFs are bought and sold on stock exchanges, just like individual stocks. You can trade them throughout the day, which is different from traditional index funds.
Exactly. And that's where Bogle sees a potential problem. He worries that this ease of trading, it encourages speculation and short-term thinking, the exact opposite of what he advocates for.
So even though ETFs are often marketed as a way to get like low-cost exposure to the market, the way they are traded can tempt investors to jump in and out trying to time the market or chase those quick returns.
Precisely. It's like giving someone a perfectly good hammer and then watching them try to use it. The application is all wrong.
Well said. So are ETFs inherently bad, or is it more nuanced than that?
Bogle's concern isn't so much with ETFs themselves, but with how they're often used. He worries that they can be a gateway to bad investing habits. Chasing performance, trading excessively, and losing sight of the long-term game. Remember, Bogle's whole philosophy is built around tuning out the noise, accepting market returns, and minimizing costs.
Focus on what you can control, not on what you can't. It's a refreshing perspective in a world that often feels obsessed with short-term gains and flashy strategies.
Exactly. Now, while Bogle has his reservations about ETFs, he reserves his strongest words of caution for a different breed altogether, specialized ETFs. These track increasingly narrow slices of the market, like specific sectors, countries, or even commodities.
So instead of owning the entire stock market, you could say buy an ETF that only tracks like cybersecurity companies or the price of gold?
Precisely. And while these niche ETFs might have a place in a more sophisticated investor's portfolio, Bogle worries that they are often misused by investors enticed by the allure of quick riches, by betting on the next big thing.
So they're essentially taking the worst aspects of actively managed funds, the high costs, the performance chasing, the speculation, and dressing them up as index funds.
That's a very astute observation. And here's the kicker. Many of these specialized ETFs have much higher expense ratios than those broad market index funds that Bogle champions.
So not only are they taking on more risk and engaging in more speculation, they're paying a premium for the privilege.
It's a classic case of complexity for the sake of complexity, which, as Bogle would argue, really benefits the investor in the long run.
It seems counterintuitive, but
Yeah.
sometimes the simplest approach is the most effective. Now, we've covered a lot of ground here, from the perils of costs and speculation to the power of simplicity in index funds. But before we wrap things up, I'm curious to bring another investing legend into the mix, Benjamin Graham.
An excellent choice. Graham, often called the father of value investing, was writing decades before index funds even existed. It's fascinating to consider how his principles align with Bogle's.
Exactly. For instance, Graham was a huge proponent of value investing, finding those diamonds in the rough, those undervalued companies with strong fundamentals.
Exactly. He believed that the market often mispriced stocks in the short term, creating opportunities for savvy investors to buy low and sell high.
Which sounds a lot like what those fundamentally weighted index funds are trying to do, but on a broader scale, they're applying those value investing principles to the entire market.
That's a keen observation. Bogle actually addresses this in his book. He suggests that Graham would have been, intrigued by the idea of fundamentally weighted index funds. But being the pragmatist he was, Graham likely wouldn't have bet the farm on their ability to consistently outperform the market. You see, Graham was a realist. He understood the power of market forces to correct mispricings, making it challenging for any strategy to consistently find those hidden gems.
So Graham might have seen those fundamentally weighted indexes as a clever attempt to systematize his value investing approach, but probably wouldn't have viewed them as a guaranteed path to riches.
Precisely. And here's the most compelling part. Bogle believes that despite being a master stock picker, Graham would have been a huge advocate for index funds.
Now that's surprising. Why would Graham, a champion of finding undervalued companies, embrace something as simple and passive as an index fund?
Well, Graham was all about minimizing risk and maximizing returns for the long-term investor. He understood that most investors, even the pros, weren't very good at picking individual stocks or timing the market. In fact, he famously said that the investor's chief problem and even his worst enemy is likely to be himself.
Human nature often gets in the way of rational decision making, especially when it comes to money.
Exactly. And that's why I think Graham would have appreciated the discipline and simplicity that index funds offer. They remove emotion from the equation, providing a low-cost, diversified way to capture the market's return. Remember, Graham was all about owning good businesses for the long haul, and that's precisely what index funds allow you to do.
So while Graham was undoubtedly a brilliant stock picker himself, he likely would have acknowledged that for the average investor, index funds are a more reliable path to building wealth over time.
Exactly. And get this, Bogle even quotes Graham as saying that for most people, the best way to invest in common stocks is to buy an index fund. High praise from one of the investing greats.
That's quite the endorsement. So as we wrap up this deep dive into John Bogle's investment philosophy, what are the key takeaways our listeners should hold on to?
For me, it boils down to this: embrace simplicity and remember that investing doesn't need to be complicated. Don't try to outsmart the market or chase the latest fads. Don't get caught up in the illusion of expertise or fall prey to high fees. Instead, focus on the timeless principles of low costs, diversification, and a long-term perspective.
Those are the cornerstones of Bogle's common sense approach. And frankly, they make a lot of sense.
They do. And remember, if an investment sounds too good to be true, it probably is.
Wise words to live by. Thank you for joining us on this deep dive into the world of common sense investing. Until next time, happy investing, everyone. So we're back, and I'm eager to kind of unpack this connection between Bogle's philosophy and the wisdom of Benjamin Graham.
Yeah, it's fascinating how even though Graham was writing in a totally different era, his core investing principles remain like incredibly relevant today.
Absolutely. For instance, Graham was like a huge proponent of value investing, right? Finding
Yeah.
those diamonds in the rough, those undervalued companies with strong fundamentals.
Exactly. He believed that the market often mispriced stocks in the short term, creating these opportunities for savvy investors to buy low and sell high.
Which sounds a lot like what those fundamentally weighted index funds are trying to do,
Yeah.
but on a broader scale.
Yeah.
They're applying those value investing principles to the entire market.
That's a keen observation. Bogle actually addresses this in his book. He suggests that Graham would have been intrigued by the idea of fundamentally weighted index funds, but being the pragmatist that he was, Graham likely wouldn't have bet the farm on their ability to consistently outperform the market. You see, Graham, he was a realist. He understood the power of market forces to correct these mispricings, making it challenging for any strategy to consistently find those hidden gems.
But Graham might have seen those fundamentally weighted indexes as a clever attempt to kind of systematize his value investing approach.
Yeah.
But probably wouldn't have viewed them as like a guaranteed path to riches, right?
Precisely. And here's the most compelling part. Bogle believes that despite being a master stock picker, Graham would have been a huge advocate for index funds.
Now that's surprising. Why would Graham, a champion of finding these undervalued companies, embrace something as simple and passive as an index fund?
Well, Graham was all about minimizing risk and maximizing returns, right? For the long-term investor, he understood that most investors, even the pros, weren't very good at picking individual stocks or timing the market. In fact, he famously said that the investor's chief problem and even his worst enemy is likely to be himself.
Human nature often gets in the way of rational decision making, right?
Yeah.
Especially when it comes to money.
Exactly. And that's why I think, Graham would have appreciated the discipline and the simplicity that index funds offer. They remove that emotion from the equation, providing a low cost, diversified way to capture the market's return. Remember, Graham was all about, owning good businesses for the long haul, and that's precisely what index funds allow you to do.
So while Graham was undoubtedly a brilliant stock picker himself, he likely would have acknowledged that for the average investor, index funds are a more reliable path to building wealth over time.
Exactly. And get this, Bogle even quotes Graham as saying that for most people, the best way to invest in common stocks is to buy an index fund. High praise from one of the investing greats.
That's quite the endorsement.
Yeah.
So as we wrap up this deep dive into John Bogle's investment philosophy, what are the key takeaways our listeners should hold on to?
For me, it boils down to this: embrace simplicity, and remember that investing doesn't need to be complicated. Don't try to outsmart the market or chase the latest fads. Don't get caught up in the illusion of expertise or fall prey to those high fees. Instead, focus on those timeless principles: low costs, diversification, and a long-term perspective.
Those are the cornerstones of Bogle's common sense approach, and frankly, they make a lot of sense.
They do. And remember, if an investment sounds too good to be true, it probably is.
Wise words to live by. Thank you for joining us on this deep dive into the world of common sense investing. Until next time, happy investing, everyone.